Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. It is a subdued start to the expiry week. The Nifty is trading in the 70-point range, though above the 11,700 mark. RBI Deputy Governor Viral Acharya has resigned 6 months ahead of the completion of his term. The RBI says his resignation is under consideration. The money markets have shown no adverse reaction. The Bimal Jalan Committee will once again in July finalize its recommendations. It will submit its report to the RBI post the budget on July 5th. Glenmark Pharma has fallen the most in 4 months after the US FDA has issued a complete response letter to the company's new drug application for its nasal spray. And Lupin is trading with gains after Credit Suisse upgraded the counter to outperform rating and has also hiked its target price. Good afternoon, Neeraj. Well, Indian markets have shown some bit of resilience today, though I think we're once again under pressure, but at least we've held on to that mark of 11,700.
Yeah, it's been a nothing kind of a day, yes, but largely no pressure for our markets, to be honest. So off the highs of the day, you would argue, we started off about 0.25% or thereabouts, but since then have come off and now trading flattish to marginally lower in trade. Similar trades for the Sensex. Obviously, the Nifty Bank is just about keeping its head above the water. So the Sensex in the red too, Nifty Bank just about keeping its head above the water, as I said, despite the decline. It's been the more resilient of the three major indices. The market breadth today, well, it's not a reflection of what happened or not a repeat of what happened in Friday's session, but well, the declines still have an advantage over the advances. Let me move on to the large caps and get the heat map and tell you what's moving and what's not on the larger cap end. More red than green, though you would argue that it's almost even Stevens, but it's not IT at the bottom of the heap now. Lots of other names. So old economy right out there. ONGC, JSW Steel, top losers down about 3%. Tata Steel about 2.5%. Vedanta 2.5%. There is weakness in two-wheelers with both Bajaj Auto and Eicher Motors looking slightly wobbly. And amongst the heavyweights which have corrected, you have a Reliance Industry which is down about 1.4%. So that is looking weak. Infosys and Wipro looking slightly wobbly, but the heavyweight name has to be Reliance Industries in this session. What's done well? The bounce back continues for UPL, so that's up about 4%. Good going there. Yes Bank about 3% higher. Indiabulls Housing Finance marginally higher in trade. So financials certainly have a good day because I can see even State Bank of India as well as HDFC Bank in the list of gainers. So financials doing okay. Old economy certainly under a bit of pressure. Two-wheelers under a lot of pressure. Is this getting reflected at the broader end of the spectrum too, Devina?
There are a few stocks that have made decent enough moves in today's session driven by a particular news or the other, but you've seen what the advanced decline ratio has looked like, so it's been pretty crisscross day in terms of the volatility within the broader market space as well. But coming down to individual stocks and how they've been performing, for one, Jain Irrigation was in focus this morning because of the downgrade coming in terms of the long-term issuer ratings, but the stock actually has not done all that badly. The morning opening trade was negative by about 3.5%. Post that, the stock has really shot up. Stock's now up about 14.5% at 28 odd or so. Glenmark Pharma, on the other hand, with regards to the issues on US FDA and the response letter thereabouts, the stock's down about 7.5%. And L&T is the other one. The power division has bagged a big order of about 7,000 odd crores. The stock's in focus in today's session, marginally in the green. Other stocks in the move, you've got Lakshmi Vilas Bank. Remember, we spoke to Gagan Banga in the morning, and he said that the deal with Lakshmi Vilas Bank is on track, and they're doing everything to make sure that they get this on stream pretty quickly. Stocks up about 8.5%. Divan Housing Finance is the other one, a beaten down name, rebounding in today's session about 9.5%. And Max India is doing well for itself too. That stock trades at about 68 odd rupees, up about 5.5%. Some stocks to the back of volumes that are doing well. You've got the likes of a J&K Bank, about 16.5 lakh shares have been traded there. Hathway trades with about 1 lakh plus shares, and NBCC, good price and volume action there. Closer to 1 crore shares plus have been traded on NBCC. Stocks near the 52-week high. Dr. Lal Path Labs, 52-week high is 1175. It's at 1170. SBI Life is the other one. The 52-week high is already almost nudging that. 713 is its 52-week high. Trent is the other one. And the stocks that are trading near their 52-week lows. Imami, for one, a 52-week low of 270, very close to that, just about 4 odd rupees away. And TVS US Motors at 438. That's $10 away from its 52-week low. So all of these stocks are in focus this afternoon as we set up for the last 1 hour of trade. What's happening in the futures and options space? And Navneet joins in for that. Navneet.
Thanks for that, Davina. Well, this is the expiry week for both futures as well as options, as you'll have monthly contracts expiring. Just a quick look as to how the June series so far has been for the markets, and we've underperformed, in fact, if you compare the performance to May. So Nifty is down close to about 2%, Bank Nifty down about 3%, and the mid-cap, the broader markets, as we've been highlighting, have been underperforming the benchmarks, and that continued. If you look at the Nifty mid-cap's performance for the June series, which is down about 3.5%. Let me take you through the futures then, if there is any sort of activity seen. The rollovers are still at about 25 for Nifty. Of course, for the July futures now, you'll see the open interest building up. Pull up the Bank Nifty as well, which has been trading at a discount, the Bank Nifty June futures at least. And so far, the rollovers for that stands at about 14.5. Mild bit of underperformance seen from Bank Nifty right from the word go in the morning as compared to Nifty. Remember, India volatility index was up 5% on Friday because of the geopolitical tensions that are seeing in Middle East, and once again I think now it's the day's high level for India VIX, which is up close to 6% as we speak. What sort of levels then one can expect at least till the expiry date? The most active strikes for the day are 11,800 call, 700 put and the 900 call, and that trend of out of the money call, writing for out of the money call strikes, I believe continues in today's session as well. As you can see, the open interest distribution 11,700 followed by 11,500 put strikes are sitting with a maximum open interest. Pull up the change in OI in today's session, and you will see 11,800 and the 11,900 call strikes, as you can see on your screen, have seen maximum OI addition, and at the money strike now 11,700 I think will remain in focus, as there is both addition on the put as well as the call side. So 12,000 on the upside, 11,700, probably the 50 DMA once again will be in focus from where we've seen buying coming in the last few times we've breached. That is at about 11,680 thereabouts. Stock futures, UPL, one of the top gainers on Nifty, it's moved above its 100-day moving average today. Open interest build up seen. Remember, this was an underperformer. It was down about 11% last week. So some bounce back seen in today's session, and there are some long positions seen as the July futures have seen OI addition alongside June futures. Dewan Housing touched its 52-week low of 59.7 on June 20th. From that level, it's rebounded quite sharply, though for the June series, it's still an underperformer. The stock's down about 30%. Nevertheless, this is the third straight day of gains coming in. It could be a bounce back because there were a lot of shorts sitting in the system with regard to this counter. The pharma stock Glenmark, which has been in focus, it's fallen on very high volumes in the cash side. It's also fallen to a 6-year low in today's session on back of delay in drug approval. As you can see, the white line is indicating today's volumes vis-a-vis the average volume of last 20 sessions. So that's telling you on the cash side there is heavy selling coming in for Glenmark. And lastly, just want to highlight IGL, just on the trends of OI build-up, though the stock's down for the second straight day, it could also be a day's low, down 4%. Look at the build-up, July open interest. Of course, it's going to come in on a very low base, but still there is significant OI build-up when it comes to IGL on the short side, and the stock's also fallen for the second straight day today.
All right, that's the F&O snapshot and what the rollover picture is at this point. Let's begin with a global voice. Nick Parsons of Thomas Lloyd Group is joining us right now on the show. Nick, thanks very much for taking out the time. Your first, your reaction to what we've been seeing with regards to the geopolitical issues with Iran and US and what that could have in store for crude oil prices and thereabouts the overall equity market sentiment.
Well, good morning from London. I think the good news and the very constructive news is the all-time high which the S&P 500 made on Thursday of last week. We then saw on Friday a little bit of profit taking. We saw investors moving to the sidelines because, of course, if you're out of the market for 2 days, all sorts of things can happen over a weekend, especially with respect to the Middle East and other tensions. So this morning, the question for investors is, are they going to come back into the market? Well, the answer tentatively thus far in Europe has been yes. The S&P has regained some of the ground it gave back on Friday. The dollar's a little bit lower. EM is starting in the green, and things look set fair. The big thing to watch, of course, is most notably for Indian markets, is the oil price, because they're particularly sensitive. Two reasons. One, of course, the current account balance, but second, not least, is the inflation outlook. So if oil can be capped at or around current levels, and we can even go back to the levels that we saw earlier of last week, then that's probably the sort of catalyst that Indian markets are looking for. But for the moment, I would say the start in Europe and the start in global markets is quiet but constructive.
You know, the foreign investor seems to be missing out in investing in India over the last few weeks, at least. We've been seeing, and like you yourself pointed out, S&P 500 has been making its record highs. We made our record highs a few weeks back, but could not hold or sustain onto those levels. Do you think that it's a little bit of a heady valuation from an India perspective that's keeping foreign investors at bay, or the prospects of another market being slightly more lucrative?
Well, I think it's in part a valuation story, but that's not the key driver. The key concern for global investors when looking at India at the moment has really been a lack of follow-through from the election. Here we are, the 24th of June. The election result was, what, the 23rd of May? So we're just 4.5 weeks since the election. And the investors are saying, well, what have we heard? What are the new policies? What's the makeup? What's going to be the priority of the new government? And for the moment, we've had something of a radio silence. Yes, locally, you can be looking at personalities, and you can be looking at the makeup of the new cabinet and how it might pan out from a purely internal perspective. But externally, investors are looking for policies. They're looking for a new direction. They want to know what the 5-year view is. And at the moment, there's been something of a silence, and investors are beginning to get somewhat restless, I think, and asking, well, we've had the election, but what's changed? And what's new? And where's the new, big, exciting story? And we're not really seeing it at the moment.
Wouldn't that be a factor of the union budget being a couple of weeks away and the announcements likely to happen then?
Yes, well, that could well be. But of course, at the moment, investors are looking elsewhere for stories. And if what we're looking at is the budget being the excuse for inactivity, and the budget being the reason, quite sensibly, why policy announcements have still got to be delayed, because they've still got to be set in that overall financial framework and context, then we're still stuck for a catalyst. It may be perfectly sound reasons, as you well explained there, but investors still want something of a story. They want some meat. And perhaps once we get there, then that will be the start for another bout of capital inflows, because everything is set fair. The US dollar is on the defensive, so we're at a 3-month low for the dollar's trade-weighted index. We've got the S&P at all-time highs, which gives a few concerns about valuations in developed markets. That also ought to be helping the EM universe. But for an India-specific catalyst, investors are saying, I don't really see anything at the moment. And it may well be that we have to wait that couple of weeks for the budget before we can then start to allocate fresh capital into the country.
Nick, you mentioned the FIs could be expecting some sort of key reforms to come in from the union budget. What is on top of the list when it comes to the expectations from the FI desk this time around?
I think really it's going to be the attitude towards foreign direct investment. Anything that can be done to speed up the process, to simplify the bureaucracy, anything that makes the purchasing of Indian rupees from overseas investors, real money investors, such as we are here at Thomas Lloyd, anything that helps to improve and facilitate and ease that process is going to be seen as a positive, as also is the general attitude to overseas capital, given the vast infrastructure requirements that you have in the country, in power, in transport, and across so many different sectors. If investors hear a welcoming story and that their foreign capital is going to be put quickly to use, and it is welcome, and we can co-partner with locals here who are going to help drive forward the infrastructure investment that India so clearly needs. If we can build on the stories of the past, then I think we've got a very, very bright future. And so capital is ready to move. Capital is ready to be allocated. All it needs is to sign that it's welcome with open arms, and the processing, the bureaucracy is going to be made somewhat easier.
Okay, Nick, we'll leave it at that. No, thanks a lot for joining us today and taking us through your views in global markets and also what the FI desk is expecting from the union budget this time around from India. All right. With regard to the markets, I think we're still below the mark of 11,700 right now, 11,695, and there is some bit of selling which has just come in the last 10-15 minutes of trade. Bank Nifty, however, is still sitting just about flattish in the session. All right, moving on to some corporate conversations. Delayed monsoon may dry up sales for agrochemical makers in June, so it is going to be a tense quarter, especially for those companies that are excessively reliant on domestic sales. To know more about the situation on the ground, we spoke to the management of Dhanuka Agritech's Managing Director M.K. Dhanuka, and this is what he had to say.
As per IMD, the monsoon should remain normal, although it is delayed. And initially, the forecast was also there that June rainfall will be less, but from July onwards, the momentum will be gained and the rainfall will be normal. So everyone is in a wait and watch mode. And yesterday, the monsoon has hit the 10 states of India. So we hope that in next couple of days, it will cover the rest of the India. And because in India, still agriculture is dependent on monsoon, and 60% of the farmers, and they are dependent on the rain-fed only. Only 40% irrigation is there. So it's very important that we should have a normal rainfall for the Indian economy also.
But so far, how has the offtake been? And while the IMD is projecting a normal monsoon, is that showing in terms of the kind of order of takes?
No, frankly, you know, the sowing has been delayed because of the delay in monsoon. So we foresee that some sales of the first quarter will be shifted to the second quarter. Say for the month of June, some sales will be shifted to July. So this quarter should not be that great, but definitely always the second quarter is the most important quarter for any agchem company, because after the monsoon only the offtake starts and the major season starts. So we hope July, August, September, these 3 months will be very good growth month for Dhanuka.
Okay, but nonetheless, will that still leave you with a large pile-up of inventories? That was the problem that you faced in the last financial year?
No, in the channel we don't keep the inventory because we are just supplying in time to the distributors.
Okay.
Whatever is inventory is there, that we are building up for the season so that we can meet out the immediate requirements of the dealers and distributors. So I don't foresee that Dhanuka is having any challenge about the inventory.
In a recent commentary, Mr. Dhanuka, you'd highlighted that the FY20, you see the year changing in terms of the growth pickup, revenue pickup, and you expect revenues to go back to levels of about 10 to 15 odd %. Are you on track with that, or do you see the slowdown continuing?
In this quarter, since the monsoon is delayed, I don't expect much growth, but definitely from second quarter onwards and for the whole year, we are looking and confident that we will deliver at least double-digit growth by March 2020.
Would that mean your margins will also revert back to FY18 margins of about 17-18%?
Yeah, we are confident of improving in the margin also, and in our con call earlier also we have confirmed that minimum 100 bips improvement will be there over the last year.
Would you be able to tell us with regards to new product launches if they are on track? Because I believe last time around they got a bit delayed and therefore they were pushed out of FY19.
Yeah, this year we have already launched 3 molecules in the month of May, One is Kempa, which is a rice herbicide, and the second, this is from Nissan Chemical Japan. The second product is Largo, which is very good on the thrips. And recently, one new insect has entered in India, that is fall armyworm, and the Largo gives very good control for that fall armyworm also. And the third product is Apply. So we are banking on mainly on Kempa and the Largo.
What about the others like Cover, Sakura, Luster, Maxoy?
They are doing reasonably well, but we don't foresee any major growth. Luster raw material is not available, so that's the problem. So growth will not come in Luster, although demand is good, but because of the non-availability of raw material. But other products definitely are available, and we hope that a reasonable growth of around 10% we will have in this year also.
So on a yearly basis for the next 3 to 4 years, you're anticipating at least 2 new product launches?
Yeah, that is there. Always there remains 8 products in pipeline. So on an average, we hope that 932 molecules we will be able to launch every year.
Okay. And how much do you think that will contribute to the top line in about, and how much period of time will that take to contribute to the top line?
It takes minimum 3 years' time to get a reasonable market share, because when you come out with a new molecule, neither a farmer nor a dealer knows about the product, and you have to educate them by providing training. So from 3rd year onwards, you start getting the volumes for the new molecules.
Okay. Are you expecting normalization raw material costs, Mr. Dhanuka, or that continues to niggle as a pressure point?
We cannot expect the prices of 2017 in raw material, but definitely the prices has softened in comparison to 2018 in most of the raw materials. 2-3 molecules which are not available, where the prices are increasing, but otherwise, in general, the prices has come down in comparison to last year.
Okay. And coming to the fact that, a lot has been riding on what the government does with regards to the trust to the agriculture sector, and will that actually provide a fillip to the farm activities and in turn translate to adding numbers for yourself? How do you, how have you viewed the fact that there could be a bigger fillip in terms of farm activities?
Yeah, definitely. Now the thrust of the government is to improve the financial condition of the farmers and rural development. So once the benefit of the policies announced by the government starts reaching to maximum number of farmers, and there is more money in the pocket of the farmer, we hope that after a year or two, the situation will definitely change. As the government has said, by 2022, they will double the farmers' income. The minimum support price every year they are increasing. The soil health card, the crop insurance, all these benefits when farmers reach to the farmers in maximum number, we hope that this agriculture sector will get the momentum, and the companies related to agriculture, they will definitely have to get the benefit of same.
All right, that's the management at Dhanuka Agritech still saying that Q1 of FY20 is going to be a pressure quarter. You'll start seeing some turnaround from Q2. Moving on and shifting focus from equities, another asset class that has been really soaring high has been gold, which prices have hit a 6-year high last week. The yellow metal has become a safe haven for investors amidst uncertain global cues. To talk about the outlook for the metal going ahead, we're now joined by Navneet Damani of Motilal Oswal Financial Services. Navneet, thanks very much for taking out the time. Several factors obviously contributing to what leads to the increase in gold prices. One being the dovish commentary from the Fed. The other being a loading up of central banks and adding on to the gold reserves, which will lead to more support for gold prices. A third, the dollar-rupee equation. Keeping all these factors in mind, how do you expect gold prices to move going forward?
Well, you briefly covered most of the factors that are supporting gold at the moment, and it looks like one factor that we missed is a technical breakout. After a very long consolidation, we are seeing a very good up move about $1,350, $1,360. And this move is likely to push the prices immediately towards 1440 and 1470 levels immediately on the technical parameters. Also, the kind of buying that we are seeing from the SPTR and the CFTC holdings, which are changing a stance from a net short position to a net long position, is adding to the confidence that gold prices are likely to sustain, and the medium-term outlook is going to be positive. So on the domestic front, we believe that 35,100, 35,200 is a level where we can see gold prices taking some breather, and eventually for the next couple of quarters, prices are likely to stay on an upward bias.
You briefly alluded to the CFTC positions turning long. I think it started somewhere closer to the month of February. Has it continued to stay long, and does this give a lot of comfort with regards to gold prices?
Yeah, it started from February, and gradually prices were trying to inch up but couldn't manage well. But after the Fed turning dovish and possibility of rate cut scenario in the next meeting, and also geopolitical tension escalating, the longs have taken a big addition, and that is kind of supported to metal. And we believe that this is likely to add some more gains to the gold prices.
Okay. From an MCX gold point of view, is there a trade that can be taken on domestic gold?
We believe that the prices have seen about 7-8% move straight upwards. So any retracement by about 1.5% could be a good opportunity. Currently trading about 34,300. We believe anywhere close to 34,000 is a good level to enter, which stops below 35,300, targeting 35,100 on the upside.
The last few months, in fact, year to date, if you were to look at what MCX gold has done versus what we've seen, dollar gold prices at, the divergence, what have you attributed that to?
The divergence predominantly is because of the rupee factor, where we started the year at 71 to the rupee, and currently it's about 2% lower. So that is one factor which is kind of pushing the MCX prices lower as compared to the dollar prices. But domestic gold prices have not seen a good uptick as we've seen in the MCX prices. They are trading about 1.5% lower on the domestic market, domestic physical market today. So until we see real physical demand coming in India, these MCX prices are likely to have some kind of a disconnect with the international gold prices.
Nonetheless, the strength in the currency, we're about 69.5 odd. Does that augur well to actually hold the commodity now, because owning the commodity becomes that much more cheaper versus the dollar?
We have good confidence that gold prices eventually are likely to, and there is no other way that you can hold gold. If we take out the dollar, if we take out the rupee factor from it, still it looks very attractive, and we believe that 7-8% up move from here also is very much possible over the next couple of quarters. So barring the rupee factor, it's a good bet to hold in on the rupee terms as well.
All right, Navneet, we'll leave it at that. Thank you so very much for joining in with that. So gold still looking like a lucrative bet. However, MCX gold prices seems to be taking a little bit, seems to be curtailed a bit because of what the currency has been doing.
Just want to divert attention back to the markets. I think we've breached the 50 DMA, and just want to remind our viewers, on Nifty we've breached the 50 DMA. Every time we cross this in the last few trading sessions, there has been some bit of buying which has come in, but right now with the day's low, Bank Nifty has also slipped into the red, down about 37 points, and Nifty just about hovering. It's also breached, but it's hovering around its 50 DMA right now.
It's looking slightly wobbly. Let's wait and watch what happens. The banks too have turned marginally in the red, but no alarm bells really. It's just about 1/3% in the red currently. I just want to bring up the dichotomy in performance between the ADAG group companies. So Reliance Capital and Reliance Infra, the two names in the F&O ban, are trading in the green. The others, the penny stocks, aren't. But these two, okay, Reliance Infra now has moved into the red. At the start of the show, it was trading in the green. Those two are trading okay, but otherwise, a clutch of others weren't doing all that well. We'll be talking about them during the course of the week as well. Expiry week, important one at that. However, just before we get full tilt or move full tilt towards the equity markets in the last 1 hour, talk about another development that maybe didn't happen. The 6-member economic capital framework on RBI reserves met and will meet again in July. The committee, which was supposed to hold its last meeting today, has sought more time after the government representative, Finance Secretary Subhash Chandra Garg, did not attend the meet. Nikunj Ori joins us with the details. Nikunj.
The panel tasked to decide surplus RBI should hold on to its books has deferred its report for the second time. The panel, headed by former RBI Governor Mr. Bimal Jalan, was supposed to submit its report on April end, but had sought a 3-month extension till June end. Now the panel will meet again in July and will submit its report after the new government presents its maiden budget on July 5. The panel is also working on difference in opinion amongst panel members. Most of the members, except Finance Secretary Mr. Subhash Chandra Garg, are not in favor of relaxing the formula used to calculate the capital needs of the RBI. Mr. Garg has also skipped today's meeting, which was expected to be the last meeting of the RBI panel. Over to you.
All right, let's get you some technical ideas going in the markets, whether there is any trade that one can take this Monday afternoon, considering this is also the expiry week. We're joined by Hemen Kapadia of KRChoksey right here with us in the studios. Hi, Hemen, good afternoon. Well, so far, I think we were resilient, but just in the last half an hour or so, there is some selling pressure definitely visible in the market. We're trading around the 50 DMA. Would you take any position, keeping in mind that the expiry is on Thursday?
Not exactly, but I think we're still stuck in the range now. So the Nifty will be an easier thing to do. 12 to call July, 11 for put July. So I've extended the range by 100 points. It goes nowhere. And a buy on ITC at 275, stop loss 272, target 281. And I think that stocks like ACC and some of the cement things are a bit oversold. So I have a buy on ACC at 1530, stop loss 1515. Target 1560, so it's going to remain iffy. 34 stocks going out now. So yes, I think it's not exactly a very conducive atmosphere for trading though.
Yep, just a counter question, and that is 34 stocks will be moving out. Last day of trading will be Thursday. And a lot of those stocks, they are beaten down. We've seen recovery coming by from the likes of Jain Irrigation, Suzlon, you name it, and IRB Infra from the ADAG pack as well. They may not be doing too much, but we've seen some sharper bounce back coming in the form of Jet Airways. Is there any trade that you would recommend in any of these stocks, considering there were heavy shorts sitting on them at least till Thursday?
Tempting, but no. If Jain Irrigation moved 65% in 4 days, it's just one short covering. And I think, if I understand correctly, correct me if I'm wrong, Navneet, I think Jain Irrigation, some of these stocks might have to be squared off by tomorrow and not till Thursday. At least that's what I've been given to understand. But nevertheless, that or otherwise, no, I don't think so. Frankly speaking, they should have been kicked out of the F&O segment months ago. You don't wait for a stock to become zero or a penny stock to say that now we don't need them in the F&O. They shouldn't have been for the last year or so.
Well, let's wait and watch what happens here. Okay, before we move on and take some other stock ideas, let's talk about some key names that have been amongst the highlights in the session today. Lupin is trading with gains after Credit Suisse upgraded the stock to outperform and also hike the price target. Darshan is here with the details. Darshan.
Yeah, so Neeraj, why Credit Suisse is important is because, almost 3 years ago, they turned negative on Lupin and they turned at their peak, indicating that, 3 of the key drugs, including Fortimet and Glumetza, are a big product concentration risk, and then exactly played out that way. Lupin actually from levels in excess of 1800 to almost 2000 came down to levels of 600, 700. Now what Credit Suisse is saying is now they believe that most of the worst is priced out. They've upgraded the stock to an outperform and raised the target price to 680 at this point of time. What they're saying is that one of the key drugs that they have, Solosec, the ramp up and the margin contraction concerns have been played out. The stock is now ignoring two important things: that the sharp increase in free cash flows over the next few years and sharp product opportunities in some of the key products in Europe as well as US. So that is something that the market is ignoring at this point of time. What the analyst says is that the sharp increase in FCF is expected and Lupin can be close to debt free in FY23. Remember, they took on debt because they acquired a lot of companies in the US markets, especially Gavis. The free cash flow should increase 3 times over the next 3 years, according to the analyst. And two of the key drugs, that is Sprivara as well as Embrel, can add almost 56 rupees per share to the SOTP, but that is ignored by the market.
Okay, now that's Lupin, which was of course doing well, but one stock that is not doing too well is Glenmark. The FDA has issued a complete response letter to the new drug application. Darshan, Did we anticipate a 7.5% drop, and what's the rationale for this?
See, I don't think anyone anticipated a 7% drop, but Glenmark is trading extremely weak. Once in such markets, when you start hitting 52-week low and in such weak environment, that won't stop. I was just taking a look at some of the numbers. While the pharma index on a year-to-date basis is down pretty much in single digit or probably 10-12%, Glenmark is down almost 35%, and it's the worst performing stock in the pharma index. And obviously this adds because the positive news are not coming in, and whatever positive was anticipated is now turning out to be negative. Now coming to this news, what has happened is that the launch was expected to happen in probably close to this time around. Then the US FDA took its time and it delayed it. Now the response that they've given is that they have problems with this drug, and Glenmark, and because of the API substance used and the manufacturing plant. Now Glenmark will have to go ahead and rectify this, and so that means that the product delay will definitely happen. They see the resolution within 3 to 9 months. So another 3 to 9 months will probably go in which nothing will come in from this important drug. Now if you're looking at some of the brokerages that have come out, Macquarie is saying that now deficiencies within there were no deficiencies within the clinic data supporting the NDA, but the deal is that the launch will now get extended to the second half of next fiscal. They're saying that they will have to incur a lot of these costs, because remember, this is a branded product, it's not a generic. So you will have to spend significantly to ramp up market share, and then only can you anticipate partners to come in. And in case they have an out-licensing deal, that could reduce the burden, but that would also mean shelling out money from whatever profits you get to the partner. HDFC Sec also believes that they had anticipated $70 to $100 million from this drug. That is big considering the state of financial affairs that we're seeing, but they will need to spend more to scale up on the product. So not the best of views coming in by the analyst community on Glenmark.
Okay, thanks a lot for that, Darshan. Well, key stocks to monitor today, and certainly under pressure is Glenmark, though you would argue that not all pharma stocks have looked under stress today. Hemen, how would you look at both of these names, Glenmark as well as Lupin, the one that Darshan spoke about earlier?
I think Glenmark 2.5-year highest volume, Neeraj. I think the entire pharma pack, which was promising, has slipped back into correction thanks to Sun, Glenmark, and sometimes Lupin. Now Glenmark continues. So I think we've had a brilliant run in pharma, 2009 to 2015. 2015 to 19 is where we're correcting. I believe that there's going to be further pain. I don't see a doubt in that. But I believe if you have a longer term point of view, and in the next quarters, next 2 quarters is when I think I'd see a medium, if not a longer term bottom from pharma. So same thing with Glenmark. Near term oversold, but yeah, I think it's broken. It's at multi-year lows, Neeraj. I believe we are at the lowest point since May 13. So looks bad. But somewhere close to December, I'd say screaming buy for the next 3 years. Lupin, we've been hanging on a precipice, so to speak. 720, 700 was important. We broke that, came back. Dead cat bounce could continue further. But the outlook still remains choppy, negative. I think couple of quarters more, Neeraj. And I think the next 3-4 years after that, pharma should be regaining its former glory.
Okay, that's a quick take on pharma and a few stocks there, Glenmark, Lupin, and what the rest of the pack is doing. Parthiv Shah of TRACOM Stockbrokers is joining us on the show right now. Parthiv, I believe first time on Countdown, but nonetheless, welcome and good afternoon to you. What are you doing right now with regards to fresh investments? We've been looking at several pockets now. The usual suspects that have already attracted a lot of investments, while some sitting on the edge in other sectors, which could probably look like good investments in the near term. What's your approach now?
Good afternoon, Devina, and thank you for having me on the show. So Devina, I think I was reading a report which talked about how bipolar this entire market has been, and it's been like a nightmare last 2 years for all fund managers, for all people who manage portfolios, because I think the mirage is that, one would say that this market is at a level of 11,700. But if one checks portfolios, they are negative. And the key reason being that except for 7-8 stocks, I think this has been a market where almost, I would say, if not less, but almost 65 to 70% of the stocks are bleeding, are like below their 5-year average valuation, lower than below their 5-year average valuation, which goes to show that, markets have already discounted a lot of non-performance in terms of the earnings, which we always try and predict year on year, and I think the earnings always tends to disappoint. So I think what from now here, I think very frankly speaking, our sense is that already this is a market which is factoring in a lot of negatives, and I think we see some sense of urgency from the government, even in terms of trying to take feedback before the budget. They realize that growth is the need of the hour, and for which they might have to take many steps to stimulate. And that should, according to my view, be an inflection point for which one will have to kind of have a portfolio where we have the right kind of stocks. And I think this is a market which has punished corporate governance, which has punished bad balance sheets. So I think these two are the criteria which should be always avoided in terms of building any sort of portfolio. So I think there's still a lot of opportunity in this market. One can always have a diversified portfolio where even if we were to select 3 or 5 good sectors where there is no corporate governance related issue, where the balance sheet strength is good, and these are the type of companies which will be prepared for the next leg of capex with the internal accruals and also taking advantage of the growth story, which will certainly happen, if not now, but over the next 6 to 8 months post then.
Parthiv, stay on with us while we take some views from you in terms of individual stocks that have been in focus. But right now, moving on to our next corporate conversation, JMC Projects, a company which is also a subsidiary of Kalpataru Power Transmission, is in focus after it secured orders worth 514 crore. Well, let's get more details on these orders and the prospects of the company going ahead. We're joined by Mr. S.K. Tripathi, who is the CEO and Deputy Managing Director of the company. Mr. Tripathi, good afternoon to you, and thanks a lot for joining us today on Bloomberg Quint. Also, congratulations on this order win. Could you give us more details as to when does the execution starts and when do we see the order revenue being reflected in the P&L account?
Yeah. Good afternoon. Thank you very much. And these orders are basically coming from the mixed bag, the south, east, as well as some order in the west. And these are basically the B&F order, for which the execution cycle is 2.5 years or tending to 3 years. So yes, these orders will add to the order book, which will be definitely executed over a period of time, say next 2 years or so.
But for the work for it will start in this financial year itself, right?
Sure, definitely. Since these are in fact, the work has already started on these orders, right? Because they were in offing for quite some time.
Okay.
So, yeah.
Mr. Tripathi, was there any slowdown witnessed due to elections in terms of order inflow?
So, government side as well as on the private side, both sides there was a uncertainty. In the whole environment there was uncertainty. And that is why there has been a slow traction on every front, not only the order booking front, as well as a lot of the state governments, where they were in the election mode, the budgets were not passed. And that is why even the receivables in some of the states, as well as even in the center, some of the ministries, the funds were not available. That has led down to overall slowdown. I mean, from February to May end. I mean, even now that slowdown effect is weaning away. Otherwise, it was definitely there last 4-5 months.
Okay, so give us a sense, how does your order book look like now, and what sort of order inflow you're expecting in FY20?
So we have already given our order forecast. We are expecting, say, orders of about 6,500 this year, and for which we are very confident. I mean, this quarter itself, I mean, another 600-700 crore projects we are L1. So we should be able to reach, say, about 1,100-1,200 this quarter. I don't think order book will be challenged, going forward in the rest of the year, because almost every sector there is a traction except the real estate. So real estate being the other issues, larger issues in the economy, they are struggling, and that is why. But we are very confident that we'll handle it from the other sectors as well as from the overseas.
Okay, you operate in 2 segments, infra as well as building and factory, and last year we did see 40% plus growth coming in from your infrastructure segment. Will that be the case even in this year, or can we see some bit of outperformance coming from the other segment, that's building and factory?
So mainly growth will be coming from infrastructure only. B&F will remain more or less at the same level, or you can say a little marginal growth, because there is an overall slowdown on the building side and building and factory side in the country, across all 4 geographies, east, west, north, south.
Okay, just a last question. Are there any more orders that you've bid for and you're awaiting for the results to come by?
Yeah. So, I mean, at any given point of time, we'll have almost 3,500 to 4,000 crore orders which will be in the bid process. I'm expecting some of these bids to be opened in, say, first week or second week of July. And then we will be looking forward something in Q2. So, as a matter of bidding, and so always about this much of bids are in the process of finalization.
Okay, and a top line growth, I think you outdid last year with your guidance. Are you sticking to the guidance that you gave for FY20? That's 20%?
Same guidance, yeah.
Okay, Mr. Tripathi, we'll leave it at that note. Thanks a lot for joining us and taking us through the contours of the order win that the company has. It's a 500 plus crore order. I think there are 3 orders that they've won: residential and commercial project in South and West India, factory works from an multinational client that's worth about 112. The stock's up 2%. Remember, this is also a subsidiary of Kalpataru Power Transmission. Let's see if that stock's also moving after this news came by. JMC right now is up about 2% and Kalpataru Power is sitting with gains of about 4%.
Well, Parthiv, come in, maybe not on JMC projects, but on these power transmission companies, despite the woes in the discoms and the power generation space, the transmission companies by and large have done okay. Have run their course, you reckon, or fundamentally there is merit in looking at them, the KEC Kalpatarus of the world?
See, Neeraj, our sense is that KEC Kalpatarus of the world have been resilient business models, and you're absolutely right. Despite all the problems that the discoms have been facing in terms of the financing, I think these companies have never had extremely stretched working capital cycle or any sort of receivables problem, and they've been taking new projects. No doubt, I think these companies tend to execute projects with relatively lower EBITDA margins as compared to many other EPC plays, but then I think it's a sure volume sort of a business. And I think a company like KEC International, we have seen that they've even targeted some of the international geographies. And I think our sense is that over the next 5 years, out of the entire $650 billion worth of infrastructure spend that is being talked about, I think a decent part of it will certainly go in terms of upgradation of power transmission and distribution. Whether those orders come from Power Grid we know for the fact has a very, very strong balance sheet. And I think the beneficiaries are going to be companies like KEC International and Kalpataru Power, because they have this capacity to take in big orders. So I believe that the story is still intact, and over the next 3 to 5 years, I think these companies can do decent for one's profile.
Okay, that's Kalpataru Power. Hemen, you want to come in on the stock? It's at 528. Would you be a trader in the stock?
Kalpataru Power Transmission.
Okay. Kalpataru looks relatively fine. We are in a medium long-term uptrend. We're almost at all-time highs. Fresh buy, I don't know. If I were to, I'd keep a stop loss of 5 and 5. We've overcome that level after almost 12 trading sessions. Indicators support. There was a volume spike a couple of days back indicating strong hand the bot. MACD stochastic buy daily, weekly, monthly. Looks good. But at least currently the mid-cap, small caps have lost their flavor for the last 1.5 years, Devina. So I'm not sure, but standalone Kalpataru does look good.
Okay. That's at 528 today, and it's up about 3.5%. The other stock which I want to talk about is the TVS Motors. The stock is grinding lower and now very close to its 52-week low. 443 is where it's trading at. It's come off the day's low, but still down about 2%. It has been a period of caution within the two-wheeler space as well, and the management's not been too optimistic about the near-term prospects as well. They've got pressure coming in from elevated channel inventories. Product costs have been going up. BS6 implementation will be another factor which will increase competition for them. BS6 emission norms which come in the second half. So all of these factors really not auguring too well for TVS Motors. Parthiv, what would you do with this stock if you had it in your portfolio?
See, I would suggest an exit. The reason being that this is one two-wheeler company which was riding on a volume growth boom. They were trying to steal market share, but that was coming at the cost of a very low single-digit EBITDA margins. Vis-a-vis all of their two-wheeler peers were doing anything between 14 to 18% sort of an EBITDA margin. And TVS Motors always, the management used to talk about them trying to inch into the double-digit magical EBITDA margin figure. And now we are seeing a scenario where I think is getting very tough. Even at the cost of the margins, they probably won't be in a position to further add to their market share, nor would be they in a position to show the volume growth that they've been able to show. And there's all this talk about transition, increasing the cost of ownership of a two-wheeler due to the insurance norms. So I think there is a sure possibility of this stock getting derated, because this was a stock which kind of gave very good returns on the bank of margin expansion along with the volume expansion that they showed. So I think I would avoid this counter.
Okay. The other pocket is the agrochemical pocket, and you're probably looking at a valuation differential coming in for the companies that have actually got export exposure or global exposure versus domestic Indian players. Even in terms of overall revenue growth, if you look at companies like PI Industries, UPL, they're doing far better than Indian players like a Dhanuka Agritech. And we just spoke to the management as well. Parthiv, what's causing this big different valuation gap between the more domestically focused players versus the ones that have slightly more exposure to the export market?
See, unfortunately, all the domestic players and even the best names like Crop Sciences, we see quarter on quarter they are struggling. They're struggling in terms of the pricing power. They're struggling in terms of the inventories that are getting built up, and that's all because of lack of purchasing power, which is coming from the distressed farm sector. And I think, unfortunately, still the outlook doesn't seem to be good. Even a stock like Rallis has done nothing. I think it has introduced a lot of innovative products, but yet when the quarterly results come, they always tend to disappoint. PI Industries, I think, and UPL, I think they've done extremely well, but PI Industries also has this custom synthesis business where the order is quite good. They do tend to have dealings with a lot of global MNC agrochemical companies, and that's the key differentiator, and that's the key reason why the stock has relatively done well. Despite, I think, we liking the story in terms of long-term outlook for Crop Science, where even after the merger with Monsanto, a lot of synergies will play out. I still believe that next 3 to 6 months are going to be very difficult, and especially with the monsoon also kind of getting slightly delayed and the spread of it might not be the great this particular monsoon season. I think these companies will tend to struggle.
Okay, that's the view coming in on the agrochemical space. I just want to shift focus to the steel makers. Pull up first the Nifty Metals Index. It's fallen. It's down about 1.5%, and the drag has come owing to the fall that one is seeing for all the steel makers in trade. Tata Steel, JSW, Steel Authority, alongside Jindal Steel and Power, all of them are right now seeing some bit of cuts, and they are at days low. Remember, JSW Steel is not fully integrated. Two factors which have been weighing is the higher iron ore prices, and the second one, of course, the production from China Jan to May was up about 10%. So let me first quickly get a technical check on this one, Hemen. Any stock where you would initiate a short position considering the fall that we've seen in the last 5 to 10 minutes of trade?
Tata Steel is range bound. No need. There is a negative bias, but some of the weekly mechanical indicators are looking positive. So it's a mixed bag, frankly speaking. I'm not sure if quantified as a sell. Maybe the market is that way. JSPL, on the other hand, there's a distinct negative bias, so that looks like a sell. And if you're talking about JSW Steel, I think that is also slightly negative, but some of them are holding on to weekly and monthly support, so I wouldn't have too much of conviction doing fresh or trade.
Okay, Parthiv, come in on this one. You track the space pretty closely. One factor is, of course, higher iron ore prices. But if the production from China continues to be higher in the second half of this calendar year, the party for the steel makers will end?
See, now the biggest challenge for companies like JSW Steel, who are, I think, having excellent plants, and I think their conversion rates and their EBITDA by ton that they earn despite not having any coking coal and iron ore prices is great. But the challenge that a company like JSW Steel is going to face is the shortage of high quality of ore, and that is not only internationally. Internationally, the ore prices have scaled up through the roof, and the Chinese steel production is at a high, and a lot of steel makers are lobbying for the government to put in some sort of protection duties in this budget. We are not sure whether that's going to happen or not, but more importantly, I think come 2020 in March, I think there's going to be these auctions, and Odisha, I think, is a huge area where I think almost 40% of high grade iron ore is getting produced, and a lot of mines out there are going to go in auction. So there is some sort of uncertainty that is building in whether with these auctions, I think whether the cost of the mines and the royalty that is brought along with these auctions is going to go skyrocketing. So I think these companies are not even left with an option to import the ore, because the imported ore has become very expensive, and domestically also there's some sort of a shortage. So I think that's the key reason why we're seeing some sort of nervousness in non-integrated players like JSW Steel. But I think they are very, very efficient companies, and I think eventually government also realizes this mining related issue, and JSW Steel should be in a good position to win over some mines in Odisha. So I think we're not very negative on a stock like JSW Steel. At these levels, I think it's not very expensive, quoting at 5 times EV EBITDA multiple. So I think if one has a 2 to 3 year horizon, we are bullish on the steel demand domestically, growing at 6%, and current production levels at 106 million tons. So JSW Steel with its capex plans should benefit in the longer run.
Well, we'll watch out for these. We'll also, on the other side of the break, though, we'll also talk about the two-wheeler companies. They're all under pressure. We spoke about TVS, but the others too, Hero, Bajaj, Eicher Motors in particular, looking wobbly. How are the charts looking there? That's something that we'll try and figure out. And of course, get in one more view on some of these steel companies or some of the other metal companies too, non-steel companies. But time now for a break. As we hit out Saurabh Mukherjee of Marcellus Investment Advisors. He says investing based on quality would hold investors well, not on the basis of market cap bifurcation. In a chat with us earlier today, he also explained how to go about choosing an NBFC stock in the current scenario. Listen in.
So let me address the question in 3 different ways. Firstly, the simplest way to think of a high quality NBFC, let's focus specifically NBFC, let's not get into banks because it becomes a more convoluted discussion then. The simplest way is firstly look for a parent with enormous financial strength. It's not viable in our country to look for standalone NBFCs, but there isn't a parent with a mighty balance sheet backstopping the NBFCs. We simply don't have that. There is no track record in India of standalone NBFCs without a mighty parent being able to pull off say 10, 20 years of sustained performance without a heart attack. So look for a highly cash generative parent. So Bajaj, as you rightly said, fulfills that. I would say Murugappa/Chola also fulfills that. Secondly, look at the balance sheet and look for consistent evidence that the NBFC has brought down, reduced the tenor of their assets. And you need to focus on NBFCs whose asset tenor has been dragged down over the last 3-4 years to say as little as 2 to 3 years. And look for evidence that the tenor on liabilities, the maturity of liabilities has been dragged out. You don't want to invest in NBFCs who are borrowing consistently in the 6-month, 12-month CP market. You'd rather invest in NBFCs where the liability tenor is close to 2 years. So that you want NBFCs therefore with ALM closed, strong financial backing, and track record of consistently selecting good credits over a 10 to 15 year period. So if you look for that, yes, Bajaj and Chola pass that. I don't think the list goes too far beyond that, but that's the fundamental way of going about it. Secondly, there is no evidence at all that value investing in Indian financials, banks or NBFCs works. What there is plenty of evidence in India is if you choose high quality lenders, they might be expensive, but they're consistently giving you good returns over 10 years, over 20 years. Now, why is that? Is the third reason. Basically, if you look for a lender whose compounding slope is steep, right? Look for lenders whose compounding slope is 20-25%. In that sort of lender, even if you buy, say, expensive, say your PE multiple is here, even then you get decent compounding. The challenge, I think, is a lot of people in India get seduced by this whole notion of value investing. They end up investing in lenders, say many of the PSU PSU banks whose compounding slope is very shallow, say 10% at best. With that sort of lender, even if you buy cheap, your compounding stays disappointing. It stays below the cost of capital, and I think that's the trap people need to be aware of. There is, I mean, you can look at 20 years of data. I haven't found any evidence at all that value investing, i.e. looking for cheap PEs and turnaround situations in NBFCs and HFCs works. Look for quality, bet on quality, look for houses with strong balance sheets who are backing their NBFC subsidiaries. Look at the balance sheet, asset tenors, liability tenors, asset liability mismatch closed. I think it's very doable, and there is money to be made even today in good lenders.
Saurabh, if you were a retail investor having a fixed sum of money that you had to deploy in the current market situation, and while we've spoken a lot about financials, breaking up that pool of money into investments that could yield better returns, even from stocks that have not done well up until now. So say, for example, mid caps and small caps, which have been touted as the next favorites because of the fact that they've been trailing in valuations to the large caps. Would that pool of money be dedicated towards the broader market space, or you would still stick it to the large caps?
Look, I struggle to think of this demarcation. We apply exactly the same parameters, Devina. We apply exactly the same parameters to our small and mid cap stock selection as we do to our large cap. So I can't wake up in the morning and say I'll take 100 rupees of Devina's money, through some supernormal intuition, allocate 20% of Devina's 100 rupees to small caps, allocate the remaining 80% to large caps, say perhaps 40 to mid caps, 40 to large caps. That's just nonsense investing. If you're giving me 100 rupees to invest, I've got to be as rational about that money when I'm looking at small caps as I am at large caps. Now, it's perfectly feasible that some of my small cap investments might take longer to yield results than large caps, but not always necessarily the case. For instance, ITC is a holding in our portfolio for some while, and it hasn't had the greatest of runs over the last 3-4 years, but we are unperturbed because ITC's competitive advantage is the strength of its franchise is exactly what it was 3-4 years ago. There is no real competition to ITC, and sooner or later the government will have to relent on its stance on cigarette taxes. Similarly, there are small cap stocks in our portfolio which have done really, really well, even though their market caps are well below, say, 2 billion. Say Relaxo, for instance, has done really well for us over the last year or so, even though the market cap is below a couple of billion. So I think this notion that I will separately address small caps for you is a little artificial. Apply the same parameters that you apply to large caps, to mid caps, to small caps, and if you find companies who meet your quality filters on cash flow, on return on capital, on growth, then be as willing to buy them across the board. It might be, as you're saying, it takes a little longer for the small caps to come through, but patience in investing is one of the reasons you get paid for it. Nothing happens very quickly, but if you need to be patient with high quality small caps, so be it. Such is life.